presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compak YouTube update for April the 16th, 2024. I'm Mo Ansari, President of Compak Asset Management, and thank you for joining me today. Don't forget you can get all of this information and a lot more simply by going to compak.com/media. Compak.com/media. Just go ahead and sign into that, and you can send us your email if you'd like to get some more information. But you can get all of this simply by going to compak.com/media. You can get the podcast, which is a longer version of what I'm going to talk about right now, and a much more detailed version that we do every week. You'll get that automatically. You'll get the weekly newsletter, and whenever we have events, you will be invited. All you have to do is go to compak.com/media. Looking at the market, we are starting to the pullback. Down 1.52% last week for the S&P. Obviously, there was a lot of concern of what's going to happen with Iran and Israel. That, as we saw, massive attack on Israel, but it was well telegraphed. It was talked about. The Iranians notified everybody. We put our ships in position, and I think it was more of a show of force than anything else, but it was a big attack. And now how Israel responds to that will have an effect on the market for the quarter so far, but for the year we're still up nearly 8% for the S&P. The Russell was down more, which is not a good sign. And I think that was because interest rates went up last week and they continue to move higher. I'll take a look at the charts a little bit later on. For the year now, the small caps are down nearly 1%. NASDAQ also down only 0.5% last week and up about the same amount as the S&P. Looking last week, the best sector was technology, still holding up, but still negative. Every sector was negative, and financials was the worst because of interest rates moving higher. We had the CPI come in hotter than expected. That caused that sell-off in the market last week. And that now looking at the inflation numbers, they are starting to go up. And that is a concern for a lot of people. I'll take a look at that in a second in much more detail. Oil also was up a year ago. At the beginning of the year, it was $72 a barrel. And now it is $85 a barrel. This will show up in higher gasoline prices sooner or later. Interest rates, 4.5 for the 10-year, and that is a lot higher. And 1 week ago it was 4.39. And now we're looking at somewhere around 4.7 as the next resistance on the charts. This, when this is an inflation component, seeing inflation greater than 3%, you can see that during COVID and right after COVID, just about everything was going up more than 3%. Now going up is good. You can see that more components in the CPI are going up less than 3%. There was a big jump in auto insurance for the last 12 months. It is up nearly 22%. Rent is up 5.7. Housing is up 4.7. Restaurant meals are up 4.2. But you can see most of these overall inflation numbers are, you can see quite a few are negative, and a lot of them are below the overall inflation rate. So the biggest contributor is auto insurance, rents. Rents, as we know, and I've talked about this earlier on, last year, in the middle of last year, it takes a long time. Once rents go up, it takes a long time for them to come down. If they ever do, they might just stabilize where they are. And once rents go up, usually they don't come down, but they don't go up for long periods of time. They were going up quite a bit, and that's what was pushing inflation. Looking at the latest economic news, CPI grew 0.4% year over year, over 3.5%, higher than expected. Consumer sentiment declined to 74.9. We get retail sales. We got that for March. That was up 0.7, again stronger than expected. So the consumers are still spending. Everybody's complaining about inflation. Everybody's complaining about prices going up, but everybody is spending money. That is still the case. So people are making more money, they're spending more money, and that's what we're seeing. Auto sales we're looking at 0.5, and it came in at plus 1.1%. So their retail ex-auto is still doing very well. Looking at the manufacturing, was down in New York, but that's, again, moves a lot. Housing starts come out, and they're at 4.84, nearly 1.484, which is a little bit, it's okay. 1.3 is the average. We're above that. So we are seeing housing starts pick up a little bit more. People now are starting to come to the realization that the 2% interest rates are gone. We're not going to see them. So are we going to buy a house or not buy a house? They have to come to grips with the 6-7% mortgages that you have to look at now. Looking at the technicals, this is wave 1, wave 2 to the downside, and wave 3 to the upside. And then we get wave 4 to the downside, which we're getting. We broke below the 20-day moving average. We broke the 50-day moving average. Now support comes in somewhere around 5,000 is where I think the number is. Why 5,000? Look at the weekly chart. 49.69 is the 20-week moving average. I think that would be a wave 3 to the downside. Wave 1 up, wave 2 down, 3 up, 4 down, and then we get 5th wave to the upside, which we should get as long as we hold somewhere around 49 and change. We're this morning trading around 5,069. So we might have another 100 points or so on the downside on the S&P, which is just a normal correction, normal pullback. If we get much below that, then we'll have to start looking at somewhere around 4,600, which is the 50-week moving average. And that also happens to be close to the 200-day moving average, which is pretty far down at this point looking at the daily charts. Each one of these lines represents 1 week of trading. So I think somewhere around 5,000 to 49, this line will continue to move up. This is a 20-week. So by the time the market, this is where the market is today, when we come in these two meet, somewhere around 5,000 should be the number that I'm looking at as next support. NASDAQ completed 5 waves to the upside. Now we're starting what should contribute as an ABC. A, B to the upside, and then C to the downside is what we see. So this, instead of a 1, 2, 3, it depends on how far down we go. But NASDAQ is positive today at close to 15,921 is where we are trading today. Again, long term, looks like support is 15,577. Well, 15,600 is 5,600. Interest rates are sharply higher, and that's one thing that I'm watching very closely. This is going to be the next resistance area right here, which is 4.69. That's where I expect to see interest rates move towards. And the higher the interest rates go, the more pressure it'll put on the market. Last year, when in October everybody was talking about the Fed making 6 interest rate cuts in 2024, I said that is very far-fetched. Now we've come the absolute other side. The narrative now is, oh, the Fed might have to raise interest rates. I don't think the Fed is going to raise interest rates, but that is now the fear starting to build up in the market. So we've gone from 6 interest rate cuts to Feds raising interest rates. That is one extreme. This is the other. Reality is always somewhere in the middle. I still think that we'll get 1 or 2. I think I was looking for 3, but now I've come down to 2 because inflation is still holding up pretty well. But if the economy starts to slow, unemployment is still holding, but we need to see a slowdown in the economy for the Fed to really get aggressive. But I still think that we will get 2 interest rate cuts, if not 3, sometime this year. Small caps, that's something that I'm watching very closely. It hit our target on the upside right here, the 5th wave, and then it just fell straight down. Gone through the 50-day, headed towards the 200-day moving average, which is 190. We're trading at 195.61 this morning. So I think this is a sign, and small caps get much more affected by interest rates going up. And interest rates have gone up. Small companies can't issue bonds. Large companies have already issued bonds, borrowed as much money as they wanted to or wanted to have. Small caps have got to go to the banks, and when interest rates go up, it impacts more. And that's why I think small caps are getting hurt more. Again, don't forget to subscribe to the weekly podcast and go to compak.com/media. Those are my thoughts. Those are my views. Again, if you'd like to get more information on what we do, how we do it, if you need help with your portfolio, just send us an email, invest@compak.com, invest@compak.com, and we will be more than happy to get in touch with you. Those are my thoughts. Those are my views. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.